Hello there, welcome back to another episode of DGI Crab. Today I'm going to discuss some commonly asked questions about dividend growth stock investing. And this is just one crab's opinion. I'm not a financial advisor or licensed in any sort of way, so the opinions expressed in this video are purely my own. So always do your own due diligence before you invest in any type of security, and never invest more than you have the room to lose. So there's a lot of questions that come up when it comes to dividend growth investing. So I just want to provide my opinion on a couple of things that I see a lot. So should I dollar cost average into quality stocks? Well, if you're going to dollar cost average, which just means you're investing sort of a set amount of money every week or every 2 weeks or every month, however often you typically tend to add money to your brokerage. If you're going to dollar cost average into any single stock, then it certainly should be one of the very highest quality, like a Microsoft or a Johnson and Johnson. I have a link in the description below to my top 10 favorite dividend growth stocks of all time. Those are the types of stocks that I would be dollar cost averaging into, but I personally wouldn't dollar cost average into anything that seemed at all risky or unstable, because you just never know what it's going to do. It's hard enough to predict what something like Microsoft or Johnson and Johnson is going to do on a month-to-month basis. Usually, at least with those over the course of the long haul, they tend to go up. But I prefer with single company stocks, with single stocks, to only invest in them when their yield is at least 20% higher at the time than the 4-year average yield, because that indicates to me that it's a quality stock that's showing some at least basic signs of undervaluation. Now, dollar cost averaging into an ETF, like an S&P 500 ETF or a dividend focused ETF, where you have a lot of diversification amongst a basket of stocks, that to me feels more like a winner than to dollar cost average into a single stock. How many different stocks should I own? Well, that's really up to you in the grand scheme of things. So, and that can vary quite a bit from person to person, depending on what your goals are, what your risk tolerance is, and opinions on this range pretty widely. So I would say, if for whatever reason you decide you don't want to own any ETFs, you just want to only own individual single stocks, it's not something that I would necessarily recommend myself. It's not what my portfolio looks like. But if for whatever reason you just decide you don't want to own any ETFs, then it's probably a pretty good idea to own a fair amount of stocks, a larger number of positions, even if some of those are a bit smaller, because you'll want to have some diversification in case one of those stocks ends up doing something that you don't like it slashes the dividend, or it runs into some sort of problems where, for one reason or another, you just say, I don't think I even want to own that anymore. Or even if it's just a position that's way down in the short term, you would want to have a larger number of positions so your overall portfolio value is continuing to increase with the good positions at the time that you have. But as far as that goes, this channel is all about covering 60 individual stocks that I think are of very high quality, that have shown a lot of stability over the years, the ability to grow their dividends consistently over time. And 56 of those stocks are S&P 500 stocks. So there are companies with pretty large market caps. In addition to all of that stability, most of them have pretty wide moats. So I would say, combine quality stocks like that with at least, a couple of ETFs. So that way you have plenty of diversification, as well as some individual stocks that hopefully you'll get better returns on in the long run, because you're only buying them when they appear to be on sale. How can I tell if a stock is undervalued? Well, there's a lot of ways that you could go about doing that. You could certainly look at the PE ratio to see if that is out of balance, let's say, with the overall market or that particular sector. You could look at the average PE ratio that that particular stock has generally had to see if it's higher or lower. If it's lower at any given time, then maybe it's a bit more undervalued. You could also look at something really simple like the 52-week high and low, and you might decide, well, if the stock is trading a lot closer to the 52-week low than the 52-week high, then it might show signs of undervaluation. You could look at their free cash flow to how much debt that the company has. There's a lot of metrics that you can go about using to see if a stock is undervalued or not, and that's certainly not all of them, but those are some common ones. This channel, because we're all about dividend growth investing, I'm hoping that the stocks that I have selected are all going to be nice and stable, continue to grow their dividend. If I need to replace one eventually for whatever reason, then I'll cross that bridge when I get to it. But the main thing that I'm looking at is what is the stock's current yield today versus what it's been over the last 4 years, that 4 year average. And if I'm thinking about either initiating a position or adding to a position, I may go and look at what the average dividend yield for that stock has been even further back than that. It's pretty easy to do that on Seeking Alpha, which is my favorite site to utilize when I'm doing just that initial cursory research on stocks, and just see what has the average yield of the stock been dating back a really long time. Seeking Alpha will go back 10 years. And if it's yielding higher today than it has been over the past 10 years, then that could be a pretty good indication that that stock is undervalued. It's not always the case. There's, not all stocks are created equal, and some are of higher value than others. But again, I'm very comfortable with the 60 stocks that I've selected to cover on this particular channel. So if I see something that is yielding higher than the 4 year average, at least 20% higher than the 4 year average, and it's also higher than that 10 year average, I feel pretty darn comfortable buying it myself. Why risk investing in individual stocks instead of just buying ETFs? This is a great question, and the simple answer is there's no reason to. If you are not a stock market nerd like myself, who keeps a spreadsheet and tracks a bunch of different stocks and pays very close attention to the ups and downs in the market and what's going on with each of the individual companies, if you're not into doing that and really keeping track of the market on a daily basis, then you could certainly just go with an all ETF strategy. Definitely not a bad idea if you just want to set up some investments, dollar cost average by picking a few ETFs that you like, and just not worrying about what any individual company is doing. Then just going with ETFs is a great decision. It's so much better than non-investing at all. I would say that it is a very good idea to select your ETFs. If you're a dividend growth investor is just buying ETFs, you'll want to select your ETFs, I believe, based on your age. So I'll put another link in the description below about the best ETFs to buy according to your age. But just as a quick generalization, if you are a younger investor, like 30 or younger, I think buying the S&P 500 in ETF form is a very good idea to focus in on, and as well as maybe having a small cap ETF of some kind to get some exposure while you're young to the small cap companies. If you're in the 30 to 50 age range, then I think having more dividend focused ETFs, the closer you are in that range to 30, you might want something that's all about dividend growth or appreciation, like VIG or DGRO, are two of my favorites, where the starting yield will be in that 2-ish% range, give or take, and then the annual dividend increase year over year should be in the anywhere from like 8 to 12%. And then the closer you get to 50, you could consider something more like SCHD is very popular. So is VYM. And then one of my personal favorites is DHS, which is a monthly payer from Wisdom Tree. These are three fine options for people probably more in their 40s who want to add a little bit of a higher starting yield, still get some good quality year-over-year dividend growth, and And then finally, when you get up, into your mid to late 50s, it may be a better idea to look at acquiring ETFs that offer a lot higher starting yields. So maybe something like SPYD, which has the 80 highest yielding stocks in the S&P 500. You could also look at something like high yield bonds or covered call ETFs like like JEPI, JEPY, which is a very popular one. So you can get a higher starting yield immediately as opposed to something that grows aggressively year over year. So it's all about your horizon, your age range, whether you're buying single stocks or ETFs. When is a good time to sell a position if I'm way up or way down? Great question. Overall, you're going to be the judge of that. But for me, any of the positions that I own that are in the 60 individual stocks that I cover on this channel, I don't sell them, even if they're running way ahead. And I learned that lesson the hard way several years ago with Microsoft, where I thought, well, Microsoft's going on an absolute tear. I'm way up on this investment. I'm going to sell a lot of my position out because I think it's just run way ahead of itself, and I'm going to disperse that money into the S&P 500 ETF VOO, as well as some other individual companies that are showing signs of undervaluation. And I was wrong. Microsoft kept continuing to run up and up and up. So I hold my positions and use dividend reinvestment. If it's a position you're way down on, I would say if it's one of these 60, just do your best to be patient, allow your dividends to reinvest, bring your overall cost basis down, and continue to hold for the long term. Because unless you have a very short time horizon, you shouldn't be in a hurry to get rid of any individual quality stock, because they're going to have their peaks, they're going to have their valleys, and I don't want to try to time the market. I just want to build a lot of stable, tax advantaged, dividend paying positions that continue to increase those dividend payments consistently year over year over year. So it's not necessarily about whether they're way up or way down at a given moment. The only time that I'm considering whether they're overvalued or undervalued is if I'm about to add new money to those positions. Now, if it's a position that you bought that's way down and it's not a particularly quality stock, and maybe it's something that you picked up before you stumbled across this channel, or it's something you picked up before you learned a lot about stocks, and you're way down on it. Sometimes it is better to just cut and run and consider the losses to just be an investment in your future, right? Just a little lesson that you paid for as you were learning. I certainly made plenty of mistakes like that early in my investing career, where I didn't know what I was doing and I would just buy companies for one silly reason or another. And sometimes I got lucky and made money, and other times I didn't. And certainly more often than not, on the positions that I bought that weren't particularly good, solid companies, and just sold out of them, whether I was up or down, almost always that was a good decision, at least in my portfolio. So those are some commonly asked questions about dividend growth investing. I'm sure that you probably have some more that I didn't think of. Feel free to leave me a comment below if there are any other questions about dividend growth investing that I should think about adding to, or we're doing another video like this where I answer some questions about just general dividend growth stuff. And as I mentioned, there will be links in the video or in the description below to other videos on the channel that should be really useful to you, including a link to each of the 4 tiers, which are quality dividend growth stocks split into groups based on your age. And I will also link the ETF video, ETFs to invest in based on your age, in addition to that. Email me your questions at dgicrab@yahoo.com. My name is Colby, the DGI Crab, and I hope that you will all continue to invest. Let's get that passive income.